Welcome to the Growth Unlocked podcast. We share insights on navigating sales and scaling your business. Joining us today is BD, founder of Bluestone Flagship Investor, who has a fascinating track record defined by successful transitions and scaling of multiple businesses, demonstrating a unique ability to preserve the founder's legacy while delivering significant results through strategic growth and operational refinement. BD, thank you so much for being here.
Thank you, Mauricio, for the opportunity and being part of your podcast and your listeners.
Yeah. To kick things off, what is the outcome your clients achieve from partnering with the business?
That's great to see. So, Bluestone Flagship Investors was actually launched in 2022, and our focus is to enable a lot of investors to invest in well-vetted, passive commercial real estate investments deals, basically. So, you could be a landlord and own a property and deal with the management headache, but at some point, if you want to scale up to go further into owning more and more assets, it's difficult without giving up a lot of your time. So, what we do is we go find well-vetted commercial real estate investment deals that are passive for the investors but more active for the operators.
Right, that's powerful. Can you share a quick example of a client who achieved that specific outcome?
Sure. So when we go out to look for various different projects, these are like larger projects, right? You could buy a house and rent it out by yourself, get a second house, third house, but at some point it becomes not scalable. A lot of people like to rely on real estate to kind of build passive income and wealth over time. So at some point, they still very successful in their main business, and they want the opportunity to be able to continue to invest in real estate, but without giving up their time. That's really kind of where we go and we find larger deals, and we actually take a participation interest in those deals. Typically, these are what we call value add deals, where we don't usually do not like ground up development in commercial real estate because it comes in with a lot of risk associated with that. So we like to find older distressed buildings where we're buying them at 60 cents on the dollar, improve them, get them back to fully operating them. And when we get it back to a dollar value or a dollar 10 value, position them for exit. And the way we do it is we actually bring in investors to invest alongside of us. So as we're buying this distressed commercial real estate property, move it into being productive, move it into producing cash flow, and then as it appreciates, return of capital and enjoying the appreciation.
That's amazing. Is there a specific area you guys operate in?
We tend to focus on specific submarkets within a specific asset classes. So, for example, when we look at like multifamily, even though multifamily people think about apartments for people to rent, or as a residential, it's actually anything over 4 units, 5 units and above is considered commercial. So when we, for example, when we focus about multifamily, we like to be in growth markets. For example, Dallas, example Phoenix. There's few actually geographies in the southeast actually that we like to focus on where there's sufficient economic vectors that's really pushing for rent growth. Because typically when we're acquiring those properties, they're sitting below market rent. They're 30 years old, they're behind in terms of maintenance. As we acquire these properties, improve them, help push out up the rents, increase the cash flow on the property, and then that would result into increasing in the valuation of the property and then position it for exit. So typically, when we look at these type of multifamily apartments, we tend to focus more on landlord-friendly states. So, for example, Nevada, Texas, Arizona, where you as a landlord have much better, the law is sitting on your side in terms of evicting and unpaying tenants and so forth. We tend to shy away from other markets like California and so forth. When we're looking at other products like storage, then we look at different type of market vectors and we're more open for it from a geography standpoint. But again, depending on the asset class of what we're investing, whether it's industrial, commercial, triple net is basically commercial retail, or multifamily, we have specific markets that we like for each one of those particular assets. So it's very asset specific and sub-market specific.
That makes sense. Is there a specific core offering, I guess, or it would be personalized based on client and deals?
No, I mean, a lot of our offerings and what I tell the usually to investors is we're only structured to accommodate accredited investors. And the reason is, our entity is registered by the SEC, Security Exchange Commission, And that mandates that the investors have to be accredited. It means have to have a certain level of net worth or income. But typically, when investors come in and they speak to us, we kind of assess, their ability to kind of invest into these projects because we tell them this is passive. You don't really need the money for the next 5 years. You want to drop
Right.
money into a bucket and wait for it to grow. Once we think that they're qualified enough to kind of fit the persona of the type of investors, we typically would have to wait until an opportunity presents itself. So for us, it's not like we have ongoing projects and we can take people in, take people out. You can think about a project as like an elevator. You're ready, you're waiting for it, the elevator door opens, you actually get into the elevator, and then you go up for 5 floors, and then you exit. So it's really always time based, and it's not very liquid in the sense. It's not like a stock market. You are getting an equity share class in that investment. So you're holding a private stock in the LLC that owns the property, but it's not very liquid in the sense, right? You cannot just go sell
Right.
it, on the stock market.
And it still accounts for market fluctuation, correct? In terms of the returns at the end.
Yeah, so I mean, definitely any investment is always tied to the market,
Right.
but the difference between commercial real estate and residential real estate is residential real estate is a lot more tied to the market in the sense of comparables. So the reason your house goes up in value is because your neighbor sold their house and they sold at that price. So now your house is worth that much,
Right.
right? So that's kind of what we call comparables, dollar per square foot. They sold at this dollar per square foot, mine is that much dollar per square foot. But when it comes to commercial real estate, it's actually looked at a little bit differently or evaluated a little bit differently. Typically, commercial real estate is very much like stocks in a public company. It has a multiple of income or even a business. Typically a business is valued at a multiple of EBITDA, right? A stock
Right.
is valued with a PE, right? Price earning ratios. So same thing with commercial real estate. The net income for commercial real estate, we call it NOI, net operating income. And typically the property is valued as a multiple of that. In some markets, it's a 20x multiple. In other markets, it's 12x multiple. So when we're buying a property and it's underperforming, the NOI or the income of the property is low. As we take it, improve its operation, we might be able to double its income,
Right.
which effectively would double its value. So even though there's always going to be market fluctuation in terms of what that multiple is,
Hmm.
but typically the business plan comes in with, hey, we're going to buy this company, we're going to buy this property effectively, improve its operation, and
Right.
then actually exit out of it. Very much like what people do in a company roll up or PE, private equity, acquiring companies, acquiring businesses, improving them and selling them. The same kind of concept. We focus more on that in the commercial real estate space.
So there's I guess, a broader analysis in terms of the actual cash flow from the property, how much you can get, and from the improvements and all those things, right?
Absolutely. Now, how much you can push the rents is somehow tied to the market in some sense, because, if more net migration into a Dallas market and more demand for rent goes, you're going to see that the rent goes up. The more rent goes up,
Right.
the more net income you have. But typically, when we're acquiring a lot of these properties, we're buying them because, they're way below par. So, for example, this apartment building is 100 units, and we're buying every unit about 100,000. So it's a 10 million acquisition. Uh, but we're looking at rents, and the current rents in place are about $1,000 a door,
Right.
$1,000 an apartment. We look at, hey, what are the neighboring apartments in the area are renting for, and we might find out, hey, it's 1,300 per door, 1,300 per apartment. So we know intrinsically, once we take that property, fix it up, maybe buy it at 100,000 per door, put 20,000 per door to improve it, improve the kitchen, improve the flooring, the lighting inside. Now we can reposition it back to be renting at $1,300. So when we walk in, typically we're looking for deals where there's money to be had instead of, waiting for the market rents to go up. But part of the performa, usually when we run analysis, we run it with rent escalating or without rent escalating. So we look at like baseline return as well as, hey, what could be the best possible return?
Got it. Yeah, that's really interesting. What does a typical week look like for you as a leader in the space?
Uh, so believe it or not, a lot of Zoom calls. I mean, I'm actually in the Bay Area, California. My co-founder is in Dallas, Texas. So typically, a lot of mornings is there's going to be updates from property management. A lot of these properties, we would actually have an on-site property manager that's managing the day-to-day activities. So they would send us things like reports. We would have updates from brokers on new deals that they're coming onto the market, or opportunities to consider. Things would be like meeting with investors. Typically, we have a lot of investors always interested in saying, "Hey, I'm ready." A lot of times they reach out for us like, "Oh my God, I have a major tax problem. Can you help me?" We tend to connect them with some of our other advisors like CPAs and so forth. But there's always like, I find the majority of the time is really spent among investors. I'm going to say educating them more about how to invest into real estate and not be a landlord. I myself was a landlord at age 21. I'm going to call it accidental landlord. I bought a house and I just finished college. I started working in my tech job as a chip designer, and I actually had two roommates that were my tenants. So very quickly, kind of learned real estate at a young age. And let me tell you, it's kind of nice when people pay your mortgage without you having to worry about the mortgage, but it's also
Right.
there's weight that comes with it, and ability to scale becomes really hard. Um, so for people who are very busy with their profession, whatever they're a business owner or they're executive at a company and so forth, and they want to continue to scale up and put more of their assets out of the stock market and cashing those chips in and putting them in real estate for long-term growth, for cash flow, for appreciation, and believe it or not, for a lot of tax efficiencies. Um, they would find actually what we do quite interesting for them, because it's just a way for them to deploy their capital alongside our capital into deals that we are looking for, like double-digit returns in strong markets.
Right. So you guys are on the forefront basically of the actual deals, and they're running with the good returns than with less headache. Is that correct?
Exactly. I mean, from an investor, a passive investor standpoint, they can come in, look at all the data, vet the deal up front. They typically would ask a few questions. And then once they invest, it's pretty much that they're getting monthly reports, monthly cash flows or quarterly cash flows. They effectively become a limited partner into this project. So the project becomes, an LLC, and they're basically a passive equity partner where they get their preferred return, they get distributions, and they at the end of the year, they just get their K1s. So it's a lot more passive for them. Typically, if it's our project, we're more materially participating. It's a lot more active for us, but it allows the investors to kind of kick back and just have their money work for them instead of them,
Hmm.
having to get calls middle of the night for a toilet that's clogged, or I locked myself out of the house, or whatever it
Right.
could be.
Yeah, it's really interesting. What big milestones are you aiming for in the next year or so?
I think for us, the key thing is we're sitting right now, and it's like the cusp of where we see the stars are aligning for commercial real estate. I'll tell you, from 2022 until 2024, the interest rate's going up. And as you know, real estate is heavily dependent on interest rate. That's like the blood of real
Right.
estate. So with interest rates shooting up, it was really difficult to find deals that pencil for us. So we focused a little bit more on actually investing into debt, which is like the lending vehicles. But now, as we start seeing interest rates starting to go down, we're starting to see significant volume of deals and opportunity come our
Right.
way. And for us, it's really about capitalizing. The way we like to think about it right now is real estate is always going to be a cycle. There's a cycle where there's a lot of transaction, a lot of demand, a lot of deals, and the prices of real estate goes up because people now are paying higher multiple on a fixed
Right.
level of income. And then at some point, the market starts to soften, and you have, prices starts going down. We believe this is the bottom of the cycle right now. Where we are today in 2025, interest rates already turned around the corner, is already starting to come down. We just heard reports that inflation is going down, and we also got reports that the quantitative easing actually in Q3 is increasing. All of those vectors are going to result in what we call cap rate compression. It's just a fancy term that investors now are willing to pay higher multiple for that net income
Hmm.
that are coming out of real estate. In the last few years, for example, we had markets in Dallas where people were paying 24x multiple, shifted down all the way to 16x multiple. So now if you can buy a property at a decent income at a 16x multiple and then double that income, naturally you would expect with the lower interest rates and the more money flushing into real estate, that multiple would actually go up. So not only your net income is going to go up, your EBITDA is going to go up times 16, but that 16 factor might end up going 18 or 20. So where we see our growth is in the next couple of years, will be definitely position, like basically taking the bets right now to really position us for growth in the next 3 years as the new cycle begins.
These are amazing insights. How do you typically find and attract the ideal customers?
Yeah, so we tend to not think about our investors as customers. We tend to think about them more as partners, mainly because we are providing them a partnership. It's a true partnership
Right.
opportunity to invest alongside of us in a lot of those deals. So in some sense, yes, they are a customer, they're an avatar customer, but per se, we like to think about them more as partners. Um, Typically, like I said, because they need to be accredited we typically find them more organically attract them more. For example, both me and my co-founder are ex-tech, so we've actually worked for 25 years in tech. I've had a corporate job in tech, whatever, and managed a business unit over 300 million. So I tend to attract a lot more of that crowd. Uh, Typically, they organically um, find us online on LinkedIn, social media where we actually share knowledge and wisdom about a lot of our thesis. They tend to subscribe to our newsletters where we're always providing more content and insight, just like I told you about quantitative easing. And because a lot of them are engineers, kind of like what I am, we are very data driven people. We like to consume a lot of data, analyze the data, and give the analysis. And that's kind of what we do a lot in our newsletters. We collect the data, we analyze it, and we give our opinion. And for them, when they start reading and start getting more educated about commercial real estate versus a residential real estate, that they would start to actually slowly attract, and they end up booking calls, and we have a conversation to see if they're a good fit or qualified for investing alongside our projects.
That makes sense. So it's more of like a partnership with shared risks, and then I guess the main lead generation channel that you guys use would be LinkedIn then for informational purpose and for
Yeah, I would say
capabilities.
LinkedIn is definitely the mouth of the funnel. We're big about education. We put on a lot of local events and local areas where we put on seminars, mostly educational, or we might do like a workshop where we bring in a CPA to talk about tax strategies. We come in, we talk about commercial real estate. We bring in a life insurance person to talk about and then mainly around the areas of wealth, basically how you make money, how do you protect your money, how do you minimize your taxes, how do you get the property insurance, and how do you invest your money. So typically those are really successful events, and we often get invited to speak at a lot of other platforms. And that tends to be an area where people like us, they follow us, and then at some point they end up booking calls to talk more.
Yeah, that's interesting. So a lot of us as business owners, we go through challenges. Are there specific challenges that you guys are going through right now?
I think a lot of the challenges right now that we see is people's hesitation. There's always seems to be a misunderstanding and a miscorrelation between the stock market and how the economy is doing. People always look at the S&P 500 and they're like, oh yeah, the economy is doing great. And I was like, are you really looking at the economic indicators? Because if you really take out the seven companies that are pushing the S&P, actually all the other companies are flat to slightly going down. So where we get challenges is actually education. So believe it or not, we're actually starting a sequence of educational seminars to just teach investors how to really be financially educated. There's a huge gap in financial literacy that does exist. And frankly, I mean, even with an MBA, I don't think I learned much about that stuff. That stuff is just something I pursued later due to various aspects of interest that I had in investing, and it really opened up a lot more. So for us, where we get challenged is really the lack of financial savviness and literacy. So we have to spend a bit of time to really educate because what we don't want to do is what we call get dumb money. We really would like to
Right.
get educated investors that enter these investments, understanding, hey, what's the upside potential, but also what's the downside risk.
Right.
Um, and because that's really kind of how you win people over and over and over. Where typically a lot of our partnership are not coming in to deploy capital in one deal. They might to test out the waters, but then the moment they see it's actually working out well, they double and they quadruple and so forth. So for us, it's really about continuously coming in as we bring in more and more projects. Likewise, we've seen some really interesting stuff right now where the big beautiful bill, if you're following, much about taxes and everything else, has really reignited a lot of tax incentives for real estate owners. So for us, as soon as we're ready to exit, there's a recapture of depreciation. It's just a natural aspect. And then we're ready to deploy the money into the next deal so we can take depreciation again to offset the capital gain and this way continue to have the money working for us and for our investors. So I would say that the biggest thing is really education, getting actually investors educated. So the more we do about educating them, the more we provide content, the more we provide webinars. We typically bring in at least once a month a speaker, expert in their domain, whether it's a tax strategist or CPA or estate planning attorney, to just really give them a good idea about all the things that they should really know about when it comes to managing their own wealth.
Right. That's definitely a great strategy. In terms of um, solving that specific bottleneck with education for the investors that are going to partner with you guys, have you guys found any, tried any solutions before that didn't work out?
I mean, we tried different things, but like, between like, digital marketing funnels or for us, because people are typically not comfortable about talking about finances, we prefer to be more authentic because it's really about being authentic. So it's not necessarily about creating a video sales letter and trying to get people to buy now or we're going to discount it
Right.
50%. And if you buy, this is not what we are. This is not what we do. So a lot of what we do is really about coming authentic and really demonstrating the value of investing in something like this. What's really the expected outcome? And like I said, investing in real estate is not for everybody. Some people say, "Hey, I just rather be in control. I want liquidity. I don't see myself departing away from money for 5 years, or this project would take so long. It's not so liquid." And I keep telling them, there's a piece of your wealth bucket you have to put into the stable, continually growing, and there's a piece of your bucket you can put into, "Hey, I'm gonna roll the dice and buy some Bitcoin, or I want to buy and sell stocks." And I keep telling them, but like I said, it's not necessarily for everybody, but for people to really understand their wealth and they get over a certain level of wealth, they're like, wow, I really need to also not just, uh, grow my wealth, but also I need to protect my wealth. I need to turn part of my wealth into passive income cash flow. So at some point allows me to, retire. But believe it or not, a lot of our avatar investors that come into us, they typically sold the business, come into a lot of money, inherited a lot of money. They're like, oh my God, what are we doing now? We're panicking. We need to put it in something, but we need to put it in something that's, well protected, provides cash flow, provides growth, provides tax benefit, everything else. And that's kind of where we connect them with experts like CPA and so forth. And we show them the various different investments that we have and how would it help.
Yeah, that's great. So to get good clients, I guess it's not about just acquiring them, but also keeping them. How do you maintain relationships with the leads, with the clients?
And again, I mean, typically for a lot of leads that kind of enter, let's say, our ecosystem or our funnels, we typically, like I said, through education, offer them a lot of free things. So there's constant email that goes out, newsletter, where we're sharing insights that we're finding,
Hmm.
where we're sharing, hey, there's some new interesting tax strategies that we've uncovered. Or here's an example. Here's a test case of a person lived in the Bay Area, they're ready to leave California. Right now, they want to sell their house, but they have a huge amount of capital gain that they need to pay tax on. And here's kind of the things they have. So share with them basically other experiences of other investors they uh, they encountered because they could totally relate to a lot of those things and find themselves like, wow, okay, I really need to start thinking about some of those things before I do.
Right.
You know, I know you're in the whole accounting space and everything else, but typically the worst thing a CPA can see is like somebody already made a lot of money and now they need to figure out how to save the taxes instead of being very
Yeah.
proactive about it. You know, because so people have to get into the point where they need to start asking the questions early before they
Right.
sell or before they about to get this big boost of taxable income they're getting in terms of, hey, what are my options here? What's the right way of doing it? And how to go about it. And like I said, I mean, I've always had the passion for education. It really started with me teaching my kids, believe it or not, when they were younger, when they were like 7, 8, or 9. Later on, I actually, when I exited tech, when I retired from tech in 2019, I wanted to kind of give back. So I actually started a course of financial literacy for kids. And I still actually donate about 25% of my time into educating youth, actually.
That's
So
amazing.
that's something that I constantly keep doing to stay true to my cause. So I feel like my 1.0 journey in life, which is the 25-year in tech, you know, eh, finish got me to the point where I'm job optional. And then right now, what we're doing with Bluestone is really kind of deploying our money into, good commercial real estate project that makes money, allow other investors to come in and continue to kind of stay true to my cause, which is donate a quarter of my time into teaching youth, the next generation, about literacy.
It's amazing that you're able to give back. A lot of people miss that part, but that's really helpful for not only the community but for you as well. It's great. Um, Behind every successful business, there are key systems and workflows that keep sales and marketing running well. What are those for you guys?
Well, again, when me and my co-founder started, actually, it was just me and him wanted to do our own commercial deals, and at some point we realized that these commercial properties are just too big for us me and him individually to take him down on our own. So we're like, okay, we need to go find other investors and structure things the right way to allow these investors to go alongside of us. Because
Right,
at some point, you want to do 2 deals, 3 deals, you start running out of capital.
right,
Um, so as we started bringing in more investors, initially it was easy because it was just friends and family that know us, people that knew me in tech. So it was easy to kind of find immediate amount of money from your immediate surroundings. But as they'll get to the point where you want to scale, now you're looking at a $10 million project, a $20 million project. Now your immediate circle is just too small. So we're like, okay, how do we actually scale and be able to kind of build the relationship and authentically communicate all the stuff that we're doing to a broader set of audiences? And that's kind of where we started using social media and doing webinars and so forth to really reach out. And then as we started reaching out, we started getting a lot of leads. We're like, okay, how do we systematically go about taking these leads, nurturing the leads, putting them through various different educations, whether it's email funnels, video online courses, um, and getting them to the point where they opt in and they say, you know what, I would like to know more. I would like to raise their hand and know more. And like I said, not every person that raised their hand and say I want to know more turns into an investor. At some point, they're
right,
interested, but they may not be ready, or we might not have a deal for them. So we kind of put them into the second bucket is like, okay, interested, ready, but we don't have a deal for you, or maybe we're not a good fit. We thank them. We tell them continue to follow us
right.
until you're at the right point. So really setting up all the digital CRMs to be able to, get the avatar investor in, qualify them. Well, typically we're giving a lot of value up front where we're just giving education. Out of that, maybe a small subset would really fit into into our key customer or key investor or key partner. And then from there, just continue to nurture and continue to have a relationship. Once an investor enters our ecosystem, means becomes an investor, becomes a limited partner in any of our projects. I mean, now they have their own portal. They can log in. They can see their investment. They can see what the cash flow. They can see where the assets. They can see monthly asset reports. So that goes into the next level where they're already into our um, investment ecosystem. They have their own where they log in, where they're going to be able to get their K1s, where they're going to get their tax document, et cetera, and so forth. But initially, it's like the journey for them to getting to that point is still typically about, I'm going to say it's about nurturing and just being authentic and being available for them when they have questions to see if that's something that we can help them with or not. In many cases, if we cannot help them, we can point them into the direction of areas they
Right.
should look into. A lot of times, I keep telling investors, you know, you know, don't let the tax tail wag the investment dog because they often come in like, oh my God, I got a tax problem, this, and I'm thinking of investing into this project. And I will look at this project with oil and gas or something like that, something different. And then we start having a discussion with them, even though we're not doing oil and gas. Start having discussion with the investors, like, have you invested in oil and gas? Do you know what their risk return is? And we find out that they're actually not. They're just being sold on the idea it's a great tax benefit. While it might be a great tax benefit in one domain, you really don't want to be investing in anything because you want to save on taxes. You want to invest in anything because you want to get return. Now, there's a net benefit that it actually lowers your taxes or reduces your tax consequences. That's a fantastic thing. But oftentimes we encounter these situations where investors come in, they bring us an external investment opportunity to look at for them on their behalf and say, hey, what is your opinion on something like this? And we truly, as we start drilling into it, we realize they don't really understand it. And that's what I keep asking people, is like, please get educated. Whoever is offering you this, please go back to them. Make sure you fully understand what's the investment thesis, how your money is going to be made before you focus too much on the tax benefits.
Yeah, definitely. So there's a maturity section from sometimes the lead just coming in and then until they mature and understand the actual investments and the value behind it, and then they partner with you guys. Yeah, that makes total sense. Yeah, thank you, BD, for sharing such valuable insights today. Where can our listeners find and learn more about you and the firm?
Sure. So, I mean, I am on LinkedIn, the same way as my name is spelled here on the screen, B Dweik. Also, if they go to Bluestone Flagship Investor, we actually have a fund website. It's called BFI-fund. So Bluestone Flagship, BFI-fund.com. So between both two sources, they're there. They can always schedule time to chat and just learn more. And again, we're there to offer value for you and for your listeners, and hopefully educate more people about the value of passively investing in real estate, not just active.
Yeah, definitely. And thank you so much for tuning in to Growth Unlocked. If you found this episode helpful, please share it with a friend and subscribe. We'll be back next time with more strategies to help you scale your business.